It's 5 o'clock in London, it's midday in New York, midnight in Hong Kong, and ahead of the next day, Gong Chi Fa Chai to everybody in Hong Kong and China who might be watching this, wishing you all a fabulous year of the snake, upcoming in less than 24 hours now. It's 4 a.m. in Sydney, 9 a.m. in San Francisco, and 10:30 at night in Mumbai. Greetings, good morning, good afternoon, and good evening, depending on where you are in the world today. My name is Patrick L. Young, the IPO video live stream, Series 28, Episode 5. In the aggregate, that makes for 167 episodes, starts here. In settlement news, UK confirmation it will lag the world leaders alongside the European Union as settlement will move to T+1 in October 2027. That's going to be a mere T plus 1,232 days after the USA got there. And they weren't even the first. Over in Europe, Brussels has sensibly caved into economic reality once again when faced with the central counterparty clearinghouse issue around the euro. Efforts to force euro clearing of interest rates to Frankfurt have manifestly failed, so the EU clearinghouse exemption will be extended to 2028 as it was previously in 2021, 2024, and I imagine will be in 2031 if they don't get the message that it's not going to happen. Anybody surprised by this? Well, all I can say is clearly you aren't reading Exchange Invest, the exchange of information, the daily bulletin of the bourse business. If you want to stay ahead of market trends, remember we outlined in 2016, after the Brexit vote, why the European Union would be unable to forcibly corral clearing on the continent to the continent when London had a vast multi-currency advantage as a genuine liberal, open and traditionally pro-market financial centre. Meanwhile, speaking of genuinely open, pro-liberal with excellent Anglo-Saxon legal financial centres, great news from Abu Dhabi. IFAD is expanding, that's ICE Futures Abu Dhabi, building on the island of excellence within ADGM, that's Abu Dhabi Global Markets, the financial centre where Murban futures were born. ICE Futures Abu Dhabi are launching a move into equity derivatives. Good luck to Gary King and the team with that. That is a fabulous news. And finally, to open this segment, a report from NASDAQ this week. Absolutely fascinating, identifying between $25 billion and $50 billion in potential efficiency gains in banks' risk and compliance functions. Which reminds us that NASDAQ is nowadays a front-to-back banking software powerhouse, a leviathan, as well as being the largest exchange IT provider in the world with 130 client exchanges worldwide, as Adina Friedman was reminding us on CNBC this week. Elsewhere, NASDAQ President Tal Cohen added that 97% of the world's global systemically important banks now use NASDAQ technology. Also, heads up, NASDAQ just sold their European power business to Euronext. Get all the scoop on that at Exchange Invest. Sign up now, exchangeinvest.com. That'll be our lead story for tomorrow's newsletter. Today, we're going back to a life story. That's life story with two Fs in many respects. We're talking to a fabulous guest, Alan Dickinson. He's one of the legendary life floor local traders, having joined the Royal Exchange floor on day one in 1982, having previously worked on the London Stock Exchange and indeed at the Coffee, Sugar and Cocoa Exchange since the early 1970s. Subsequently, Alan went on to run Tower Trading in London and most recently has become chairman of TradrLab, a no-code, low-code. Oh, we love no-code, low-code, ladies and gentlemen, around here. A platform simplifying data analysis for traders. Alan, greetings. Welcome to the show. It's a joy to have you today. Tell me, where in the world are you today?
Well, thanks very much, Patrick. I don't think I can be that enthusiastic about my intro. I was slightly surprised by that, I must admit. Yeah, I'm good. I'm sitting at home. It's 5 o'clock in the evening. This is only the third one of these I've done. So you have to excuse me if I'm slow on the uptake. It's far away.
It's fabulous altogether to have you here. So, Alan, tell us, way back the early 1970s, how did you get into the financial markets in the first place?
Well, in the early 70s, the financial markets were quite a closed shop, and it had just started sort of expanding a little bit from since the Second World War and all the rest of it. And the early 70s, big boomer generation, which I was obviously one, let some of the young guys get into the sort of city and menial roles and make their way from there. But I mean, I was fortunate. I had an uncle who worked in this city, and having known him for quite some time, he sort of said, you're far too good to be doing what you're doing, which was working on the building sites. So he got me an interview up at a company called Northcotes, which was an old-fashioned stockbrokers, and I managed to impress him at the interview and got the role there, which was my start. And that was late '72, I think. And then from there, obviously, the markets were, I got a chance to go down at the Florida Stock Exchange quite early. Thought how exciting it was, and managed to get a role as a dealer down there, or as a yellow button to start with. In those days, you couldn't be a dealer till you were 20. Managed to get my dealership on my 20th birthday, which was quite a privilege. But the market itself was going through a terrible time. There was no FTSE 100 then; it was only the FTSE 30. And it was in dire straits. It was down at the lowest level it had been for many decades, and it was a pretty dour place. So a few of the youngsters like myself who'd come in from the suburbs were looking for something a little bit more exciting, and there was only two other places to go. One was the money markets, and one was the commodity markets. So I managed to get myself in at the commodity markets, on the cocoa market, which was nice. Completely different to the stock exchange, far more relaxed. Full of like-minded people like myself, rather than old school. And so I did that for 6-9 months to a year, I think, and then moved into the sugar market, which was in the same building, but they weren't sort of pits as such. It was open outcry, but it was in a room with sort of telephone exchanges all around the outside, telephone booths all around the outside, and the orders came into the booths, and you went through a central platform in the middle, which had a guy who organised the trades from A to B. So it was sort of a start of sort of open outcry, but not as we saw it on the life market.
That's actually a great point, and I must try and find a photograph from them, because where was that? It was Mark Lane. Wasn't that where they
That's right, Mark Lane, yeah.
Yeah, and I must actually try and look out a photograph of that, because that was quite a different form of dealing compared to what we ultimately saw. Well, what was being seen around the stock exchange, which was different again, and then the way that the unfettered pits took place when we got to life. But I don't want to get ahead of the narrative too quickly, because I mean, the 1970s, what an interesting time. You came into the market when the stock market was pretty much at its nadir, and I think, I think by the time we reached like 1972, 73, 74, people actually started to think there wasn't going to be a stock exchange anymore. Things had got so bad.
Yeah, I mean, it really was. I mean, the economy, but I mean, well, I was so young at the time, you didn't really take a lot of notice of the economy and what was going on. But the economy was on its knees. The stock market was, the London market especially was driven down by just a complete lack of interest, similar to what's going on today to a large extent. But, there's a lack of interest in investing in the market. And, the boomer generation hadn't acquired its wealth and its substance that it would be, and pensions in those days were all final salaries. So, the investment that needs to come into exchanges just wasn't there at that current time. And it was run in a very old-fashioned way. There was the brokers and there was the jobbers. There was no cross-fertilisation. It was very much family traded with family, an old established firm traded with old established firm, leaving huge gaps in the middle, price gaps, that in any other environment would have been taken advantage of. But you weren't allowed to there, because there was a unwritten rule of who you traded with, and you didn't query the price. And that it was only really in the sort of early 70s to mid 70s that allowing some, should we say, rather more dubious characters to come into the exchanges, that the people who would have traded at Smithfield or Billingsgate or something like that came into the markets and actually started tidying the price up and made it a competitive exchange rather than an old boys' place.
Yes, it's quite incredible. And you look at the rules of the stock exchange in the 1970s, and I mean, there were all sorts of wacky ones, because I mean, they barely allowed women in by that stage, and even then women had to turn up in a skirt. They weren't allowed to wear trousers, and there was all sorts of, I mean, it's just incredible, the opacity, let alone, as you say, the old-fashioned broker and jobber network, which was two totally separate things, and they were not even allowed to exist in the same company, which a lot of people today would find alien.
Yeah, that's right. I mean, and the risk controls there weren't any, effectively. So it was a whole different game, and it was very, very family run. Tradition at the best. They still wore the top hats in the gilt market. As you say, the first woman who came on the floor, I can't remember her real name, but I know she was known as Sweaty Betty, and I think she died last year. Actually, I remember seeing her obituary in the Telegraph. But and it was a massive hoo-ha when she came on the floor. Really weird times.
Yeah, I can remember even in the late 80s taking a group of visitors onto the floor, and they were from Stockholm, and we had this extremely pleasant, very sensibly liberated analyst from Stockholm, and she was refused access because she was in trousers, and that did not cause her to have a positive view of the London Financial Centre. Let's put it that way. The funny thing was, she was allowed to go to LIFFE. She was able to go to the LIFFE floor without a problem.
She would have been allowed on LIFFE.
Yeah. Yeah, so she'd visited LIFFE, and then we went round the corner to see the stock exchange. And as we got to the stock exchange door, a porter appeared looking extremely stressed and said, "Oh, no, I'm sorry, madam, that's improper dress." And it's like, the woman's wearing a jacket and trousers. I mean, it's like hardly improper, but yes, it was the stock exchange.
Oh, it was outrageous.
So, it's so funny. So funny.
Living in the dark ages for so long. But so when I was relieved when I left the stock exchange and went to the commodity markets, because they were more alive. They were more attuned to what I thought I'd be used to. But as I say, they weren't pits as such. They were open outcry, but organised open outcry through a central sort of platform where openings and closes were handled through a particular person who sat on the seat and called in the buyers and the sellers. But it was, it was the way forward, as we all know.
Yeah, and I've got a couple of fascinating comments, actually, which I will read to you. First of all, Mr. Christopher Messina. Good to see you, Chris, from Messy Times, his excellent podcast. Wait, were there ever non-dodgy participants on the floor? You might ask that. We couldn't possibly comment, I think, is the most appropriate answer to that one. And then we've got, here he is within his 15-minute window. We've got Tony Laporta. He comments that there's the Watergate scandal in 1972 and Nixon resigning in 1974. There wasn't a lot of trust in the stock market when the leader of the free world resigns. Yes and no, though, I would argue, Tony Laporta, because I would also say you're right. I mean, day to day, that's absolutely true. That was a huge knock for the world's leading stock market. But on the other hand, nowadays, Richard Milhouse Nixon, okay, he's got this dubious political pedigree, but doesn't he have a reputation as the greatest pro-financial market, pro-exchange president in history? He took the US dollar off the dollar standard, for good or worse. He took away commissions, fixed commissions, the New York Stock Exchange, which undoubtedly exploded the market. And I would contend, if it hadn't been for him, I don't think we would have seen all the other people thinking, we can't suddenly make a percentage on any of this, so what can we trade? And they all started moving into the development of futures markets, options markets, and so on. And thus, actually, Nixon, I still believe, was the man who started the growth of this multi-zillion dollar financial industry that you all sit on today. Notwithstanding the fact that, yeah, it was a bit of a blow when he had to resign because he'd been burgling people's offices, or at least aware of people burgling other people's offices. I don't know. You might differ. You might disagree with me, Alan. Thank you, Tony Laporta, for that great question. Thanks, Chris Messina.
Well, one of Tony's great comments is, where there's money, there's corruption. So,
can't disagree with that. Yeah. Yeah, can't disagree with that. That's geolocation par excellence, I think there, Tony. Quite right, too. So, Alan, you're in this business of coffee, sugar, and cocoa. What was that like in London? Because it's interesting to me, because I come along, gosh, a decade later or so to the markets, by which stage the whole coffee, sugar, cocoa thing in London was more or less dead. I mean, it was pretty much moribund, and life was reigning supreme amongst the dynamic markets. What was that like then in the mid-late 70s?
It was it was very exciting. We had sort of limit up, as you do in these days. You had limit up, limit down moves in the commodity markets. But the commodity markets are very different to financials, because most of them are not cash settled. They're all deliverable. So when you've got a deliverable contract, you can't. It's prone to be affected by speculators who get positioned too far one way, and it's very, very easy to be manipulated by the trade. So they can never be as deep and as liquid as the financials, because they're not cash settled. Well, especially in that day and age. But there was a lot of interest in the commodities. In the late 70s, it was quite a buzzy, a live market. And then I think we had a few situations where the clearinghouse up the margins went against the speculators, when the speculators had big positions, and it tended to drive the sort of sharp money away to a certain extent, and leave the market just for the trades to trade with themselves. And in that same sort of period, financials started to get very busy. I mean, the late 70s, early 80s, the Chicago markets really started happening, and you had the CME and the CBOT, you know, really started to fire into life. And you had the up and coming opening of the life market, which wasn't particularly accepted that well in London. It wasn't wanted. No one thought it was needed, and it was going to get in the way of what was old-fashioned business. But the commodity market was great fun.
Yeah, the commodity markets were fascinating, and I think you make a very, very good point about the genesis of life, because there's that whole period. I mean, when you started in the middle of 1972 with the Edward Heath government, which was permanently a bit of a disaster area from what I seem to recall of it, and that sort of stumbled on to 74, and then you get the Wilson-Callaghan government, which was an even greater disaster, and then you get Mrs. Thatcher. But the British establishment, all of the people who would have been the kind of the blob of that day, they weren't very quick to move with Mrs. Thatcher's revolution, which was really echoing the deregulation of Nixon and all of those other things. And also she was working in lockstep with Reagan in the USA. And I think there was a lot of reluctance, wasn't there, on the part of the old established guard to really move with that?
There was a huge reluctance. I mean, when you think, you know, the prices that used to be made in the stock market and used to be made in the gilt market and places like that, I mean, they were trading at 1/8 of a point, and they thought they were tight. They also thought they were traders, but you know, anyone can make money when you're getting hit on 1/8 quote. So you know, and you know, in their day they probably were good traders, but in the modern world, which was far more competitive, you know, they were archaic. And it was one of the reasons that they didn't really want the life market. And it was only visionary people like John Berkshire and Brian Williamson who sort of really saw what was happening in the States and saw the deregulation. You know, they saw the foreign exchange controls being taken off. You know, the whole world was changing, and they saw the opportunity for London to be listing overseas currencies and like Eurodollars and, you know, that sort of thing, and be the sort of forefront of Europe and the middle of the world for trading financials. You know, and it was their vision and their persuasion to the Bank of England, because it was the Bank of England that okayed it, and they persuaded the Bank of England to give it the backing, and the Bank of England gave it the backing. So all the old-fashioned sort of stockbrokers, money brokers, everyone else had to join in. They had no choice. So, you know, they were told what they had to do by the BOE.
Yeah, and it's an incredible period. We've got a great comment by Tony Laporte. I'm going to come to that in just a moment, actually. Thank you very much. The fascinating point of that whole time was, as you say, I mean, the Bank of England was skeptical, but at least it was willing to talk about it and let these things be done. And I remember, well, some great conversations. I mean, the late, great Sir Brian Williamson, who obviously passed away just a few months ago, such a tragedy, and John Berkshire going to the Bank of England, and the Bank of England telling them, look, the problem we have with this idea of 3-month sterling interest rate futures is that the underlying cash market is just too illiquid to support a futures market. But eventually they got talked around to having it. And I think there was famously a meeting about 3 years later where they went back, and the Bank of England said, here's all the data, and I want to tell you something fascinating. In fact, I think it was 18 months later, they went back and they said, do you know the cash sterling deposit market is actually 3 times more liquid as a result of there being futures, because people had something to hedge against. And suddenly the appearance of the hedge, even in the early, relatively imperfect day of floor trading and so on, was actually such that the Bank of England could see the benefit very rapidly. And that was quite amazing, because it was very lucky. I think it was touch and go sometimes that the Bank of England allowed it, as you say. Yeah,
it was. And I remember Berkshire and Brian Williamson, and I mean, you know, exposing the virtues of having locals, because they were, in that day and age, you know, the locals were like the market makers. Yep. You know, the exchanges now employ and pay huge sums to. You know, the locals on the exchange were the market makers. They created, there might have only been a lot of them in 1s and 2s and 3s, but, you know, they created the pricing and the liquidity at the lower end, and hugely important.
Yes, it was a hugely important issue. And let me just jump to actually to Tony Laporte while we've got this great comment here, because he's saying back to the 70s, in 1972, I was 16 years old, and my father asked if I had any money saved. Working since I was 12, I had about $1,400 in the bank from my dad's great stock pit tip. I bought 100 shares at $14. Nixon gets done up, as it were. Nixon goes and ultimately has to leave over the Watergate scandal. And my $14 stock turned into $7. It took another 7 years before the stock was a profit. That's true. I mean, that's how incredible it was. And actually, the worst thing I would imagine was by the mid-1970s, you were getting a cracking return on even certificates of deposit. So it was kind of a no-brainer avoiding the stock market at that point in time in US dollars or in sterling.
Yeah, I mean, you know, the interest rates were going through the roof. I mean, when Life first opened in '82, I think the rates were 15%.
Yeah.
Around that sort of level, you know, and it was, you know, why would you put your money in stocks with interest rates at that level? But I mean, in that era, people didn't have spare money to put into equities. I mean, different for Tony and Chicago where he was, but you know, the UK is still the same today. It's very uneducated when it comes to finance.
Yeah, and I mean it's also true that you're absolutely right. I mean, in the through the 70s and even into the early 80s, people had very, very little discretionary savings pro rata. I mean, you're talking about lots of people. Well, in fact, lots of even the people who now have become very, very famous figures in the stock market were actually kind of selling antiques or running bric-a-brac stalls on their weekends in order to bring some money in. I mean, it's quite incredible how many, particularly the SME market end of the thing, were really working two jobs in terms of what goes on. Tony Laporta adds, thank you very much for your interaction today, Tony. Tony Laporta adds, by the way, the stock was waste management. I wonder was the clue in the title of that stock, looking back perhaps with 100% the benefit of 100% hindsight, it maybe was problematic, but there you go. So the stock market cleared its act up. So to take us to this thing, I mean, when did you first kind of become aware of the fact that the Life Exchange was coming, and how did you get onto the floor?
Well, I mean, I was lucky when I was in the sugar market. The company I worked for were looking to set an office up in New York, mid '79, I think it was. And I sort of, you know, said, well, that's for me. You know, I'd been to a couple of sugar dinners out in New York, thought it was a massively exciting place, and everyone was very positive, and you know, just a completely different attitude the Americans had to the Brits. So when they were looking for someone to set the office up, I jumped at it. I think I hadn't spoken to the wife about it, and I sort of went home and said, I've just taken a job in New York. We're off in 2 weeks. And we had a 9-month-old and a sort of nearly 3-year-old at the time. So it was a bit of a shock to the system for my wife and all our friends and family. And because late 70s, there wasn't the international travel like there is these days. But anyway, so we went out to New York. I helped set up this office, did a little bit on the floor. I didn't work on the floor, but you know, the guys we were doing business with, I went and stood with them a few times on the floor, popped out to Chicago a couple of times. And when I saw the CBOT, it was just like a light bulb moment for me. It just, you know, walking into the exchange, and just the whole thing was me all over it. It was made for me. So, you know, while I was out there 2.5 years. But while I was out there, I read a few articles from in the New York Times about the steering committee that had been set up to look at this London International Financial Futures Exchange. Which to me was, you know, that was what I had to do. You know, my wife was a bit homesick. We had a few family issues. So I said to my wife, right, we're going to go home and I'm going to buy a seat. And this is what I'm going to do. Because having seen how the seat system operated in the US, where people could actually buy their own license and they could set up their own business and trade their own money, you know, that was something that was never, ever on the table in London prior to the life market. You know, you work for a company. There was no way you could buy a license to be on a floor of an exchange or in the stock market or in the commodity markets or the money markets. That was all sort of bigger companies. You could have, you know, in those days you got a very small percentage of your trading money, you know, your profits, but you earned a salary plus a bonus, which was a percentage of your trading account. So there was no chance of doing it for yourself. And I'd been trading as soon as I went over the commodity markets. I've been trading, you know, for the companies, and I was reasonably good at it. So, you know, when I saw the opportunity to come back and buy a seat on Life, that was it, job done. So I came back late '81, and you know, spoke to John Foyle and Juliet Proudlove, who were membership then at Life, and said, like, you know, I want to get involved, want to buy a seat. And you know, they said, well, you know, we're trying to encourage people to do this, but we haven't had a great take up. A few Americans bought seats, but you know, I think I was the first sort of home-based sort of guy to buy a seat and get stuck in, which, you know, I had to sort of remortgage my house and, you know, the rest of it because I think the seat was it 20 grand or 30 grand? I can't remember now.
Something
but, you know,
like that, yeah.
Mm-hmm. It was quite a lot of money in sort of '82. So we chucked it down, we bought a seat, and the rest was sort of history. But it's, you know, it wasn't great to start with, I must confess. There wasn't a huge amount going on. You know, Salomon Brothers, who were a big supporter of the life market, approached me to help them do some sort of stuff in the early days, which I did. But my ambition was always to trade the market, not to broke the market. So I very quickly, after doing a bit of Salomons business, bought another seat and employed someone or got someone to come in and do Salomons business, which left me free to trade. In hindsight, maybe I should have stuck with a broking sometimes, but that's just the way it was.
Well, I think that's the story of every trader's life. And actually, it's interesting because Tony Laporte is talking about Salomon Brothers as well. So let's go back to the latest input from Tony. Thank you very much for being so involved today. But in hindsight, in the mid-1970s, when no one wants to be involved in the stock market, that's when you want to buy it with both hands. Then in 1982, Salomon Brothers wheels out Henry Kaufman for his infamous bullish call, and the market rallied for 5 more consecutive years until the crash of 87. Absolutely true. And with hindsight, I mean, the crash of 87 was a relatively short-lived aftermath compared to, say, predecessors in the 1920s or whatever, despite the fact it was a huge day then. Thank you very much, Tony Laporte. So you went on the floor from day one, essentially under your own auspices. You were a local from day one, Alan. Oops, I think Alan might have frozen for a second. We're obviously going to get him back in just a moment. Tell you what we're going to do, as we're coming up to halfway through the screen, the program, as we wait for Alan to appear, let's talk about this week's book of the week and also our short video. First of all, our short video in Big World. Why is Europe's share of the top companies shrinking? I think it's worth looking at for a quick 1-minuter, which will be the start of our series discussing various issues to do with the world's top 100 companies. Take it away.
Meanwhile, in Big World, how is Old World Europe faring amongst the world's largest companies? Looking at the world's top 100 listed entities, I mentioned in my last video how the tale of the world's largest public firms is now a hugely US-centric phenomenon. Fully 61 of that 100 are US companies. The biggest story of the top 100 firms worldwide since the 2008 financial crisis has been the marked decline of Europe. In 2007, 46 firms in the top 100 came from Europe. Nowadays, it's less than 20, 19 to be precise. For more in Big World, like or follow.
And there we are, ladies and gentlemen, the incredible decline. I mean, once upon a time, the top 100... Just a generation ago, before Europe really fell off the bandwagon after the 2008-2009 Great Recession, there was that incredible moment. Europe had 46 of the top 100 stocks. USA nowadays 61 of the top 100 stocks. More significantly, the USA absolutely dominating the top 100 stocks. Worth thinking about the fact that yesterday alone, Nvidia lost about $440 billion worth of market value, which is roughly equivalent to the entire market capitalization of the bottom 3 stocks in the world's top 100 listed shares. And the bottom 3 stocks in the world's top 100 listed shares are a quantum larger than pretty much anything else that's on most of the world's stock exchanges throughout the world. So quite incredible. I know Alan has just returned to us. That's great. I'm going to do our books of the week, and then we will welcome back Alan into the studio. So we've got 2 for you this week, ladies and gentlemen. First of all, we've got Financing the Race to Space. Our guest from a few months ago, an IPO-VID, Armen Papazian, he has written, and it's now been published, Financing the Race to Space, How to Value, Invest, and Explore the Universe. Really, really interesting tome that to try and get through. Thoroughly recommended. That was our book of the week 2 weeks ago. Sorry, we didn't have a show last week because it was Martin Luther King Day and there was something else happening Monday week ago. Just can't quite remember now in between signed executive orders. The other book of the week, this week's book of the week, is The Elements of Investing, Easy Lessons for Every Investor by Burton Malkiel and Charles D. Ellis. Malkiel also wrote, if I remember correctly, A Random Walk Down Wall Street, which is a great book. This is a straight-talking tome about investing and saving, focusing on the essentials with simple but powerful thoughts on how to avoid Mr. Market and his loser's game and instead enjoy the winner's approach to investing. Possibly something a lot of people will be wanting to read today after a torrid day or so in the stock market as a result of all sorts of AI initiatives suddenly coming through. Well, there's Champetier and innovation for you, ladies and gentlemen. Now, back to Alan. Hello, Alan, once again.
Hi, sorry about
We
that.
have grimaces. Don't worry about it.
Unstable connection, sorry.
Don't worry whatsoever. These things happen. You didn't say anything that caused you to be banned or anything like that, so we can carry on the conversation. That's not a problem. So I just reached the point where I was saying you had essentially reached a point where you came onto the floor and you worked for yourself from the start as a local.
Yeah. Well, yeah, I mean, I think my seat didn't come through till a couple of days after the market opened. So, but I mean, you know, I was there day one trading away under someone's umbrella until my seat came through. But I was the first, you know, and the exchange sort of publicised that I was the first sort of local individual to buy a seat and trade for himself as what they called in America the locals.
Yeah, and the locals became such an important part of particularly the live floor because there really wasn't any organized corporate market making anyway through the 1980s. I mean, maybe a few Dutch blokes appeared on the floor from the EOE in Amsterdam and started making prices in a few options. But actually in futures, it was really reliant upon people like you and your cohort of locals.
Yeah, and I think after I mean, the trouble is attracting locals was quite difficult. There was a lot of order fillers who traded on the back of the orders, but there wasn't that many 100% locals, and there was a couple come over from the States like Tony Laporta who's firing you loads of questions, and Mark Stanton, and you know Tom Thays as well.
Yes.
But it's you know, there wasn't that many. It wasn't, and it really only after about, I guess, 1985, 86 when the exchange started working and was proven to be working. Because up until that time, it was touch and go if it was really going to succeed. But there was a huge sort of camaraderie amongst the early guys because there wasn't that many of us on day one, company-wise, because a lot of the companies that have been forced to buy a seat and have been forced to set an operation up on live, or not forced, but advised to by the Bank of England, didn't really want to be there. So they ended up sticking all their sort of has-been people from their normal businesses onto their life market because it was never going to work and it was an easy way of getting rid of them. And a lot of those guys turned out to be running those companies within about 6 or 7 years. So there was a large camaraderie amongst the early starters. And in hindsight, I guess it probably affected me because I was so sentimental about the exchange and so enthusiastic about the exchange. I sometimes forgot what I was there for, which was to build a business and make my fortune, or try to.
Well, it was also such good fun, wasn't it? I mean, day to day. I mean, you can't say you didn't want to go to work when you were going to the live exchange floor because it was always just a laugh.
You've never met anyone who works on the exchange that didn't love the time they were there. Well, there's very few. It was something to behold. It was just, but I've said this to other people, but it attracted the sort of people who needed that out of life. Excuse the pun. You know, it wasn't for everybody. It wasn't for the meek and mild. It was for the sort of extravagant and the extortionate and exorbitant. And you know, you had to thrive in that sort of environment, and it attracted the people who did thrive in that environment. And you knew as soon as you walked through the doors if it was for you or not. It was a fantastic place to work, and I feel very sort of fortunate and sort of grateful that I had the opportunity to work down there for the time I did.
I'm with you. I thought it was really fantastic. I couldn't believe what it was like because I came from Belfast and in one weekend and suddenly arrived in this thing which was like somewhere halfway between a National Lampoon show and incredible. But it was such an amazing democratization of markets.
Yeah.
And you made a good point. I mean, in some ways, the IDBs and all of the other money market participants, like the discount brokers and so the discount houses rather, were brought in, and as you say, they were kind of pushed into it by the Bank of England. And I can even remember my first day in sort of late 1987 that it was amazing because you had all of these fascinating collective of companies. I mean, Zarnico still had a series of people on the market floor at that point in time. Hill Samuel, 1,000 other business names that have all been conjoined into all sorts of things. But we'll get back to that in a moment, actually, Alan, because you are the man who's attracting a huge number of comments today, and they're all fabulous. Here's Tony Laporta back again. Thank you very much, Tony. It's great to hear from you once again. The crowd Yes, indeed. You know, you saw stocks falling 30% in 4 days, culminating with a 22.6% drop on Black Monday, just for your information. But as you point out, Wall Street finished higher in 1987 than it had started 1987. Chris Messina, thank you very, very much. Tony Laporta once again. Chris Messina's back. Imagine that. Free markets and lower regulation, along with finally ignoring the global climate hysteria churches. Absurd proclamations led to capital aggregation. Who knew? I think this was in the time when people were still writing books about the earth cooling, actually, that stage, Chris. But yes, I get your point. It's a very, very apt one. David Kempton, hello, welcome to the show. I do believe this is your first contribution, so lovely to hear from you. What a great watch, chaps. Went for my first interview as a 17-year-old with Alan, and even as I walked onto the floor in 1983, I thought, wow, this is a bit of me. Thank you very, very much for your contribution, Dave. Really appreciate that altogether. And good grief, we've got more comments lining up as we go along, actually. Olivier Guerre, salut mon ami. Olivier, also an IPO-VID alumnus. Go watch his show. Really, really interesting show from, oh, good grief, when was that? 18 months ago, 2 years ago, Olivier? Anyway, I hope if you're in Astana, I hope it's not too cold today. I will respectfully disagree with Alan on locals. They weren't market makers, in my humble opinion, just outright scalpers. But their presence would ensure that brokers find sufficient quantity at any time to get in or out of the market in a microsecond. It's an interesting point, that actually, Alan. And before I come to you for a comment, it's also apt because the Financial Times has got a thing today. They've got a study from the Review of Finance, I think it is, talking about how their analysis, a series of pointy-headed academics, have discovered the fact that all of a sudden, you know what, having all these algos in market is good. But in fact, markets that have humans in the middle of it can be better. And I would have said that was possibly quite a good argument for the scalper. We might be able to see a brief graphic of that FT article. It's an FT Alphaville by, I do believe by, oh gosh, now I've forgotten your name, Robin Wigglesworth, isn't that right? Anyway, human traders are valuable. Actually, I think all of us knew human traders are valuable all the way along. It was just that it became a bit expensive to have 45,000 square feet of prime London real estate with all of them in it. That was one of the challenges at one point in time. Alan, what do you think about my witterings and indeed Olivier's comment on scalpers?
I can see why he says that, but I mean, you know, we're just saying that they were market makers insofar as there wasn't a market making system, so they were creating price liquidity and depth, even if it was only small sometimes. So it's maybe just it's the word that's probably wrong. But yeah, I mean, and going to your point in the FT, I mean, there's a huge need for the human element in trading. There's room for both, but you know, we were scalpers on the floor, and we had the edge. You can't expect individuals to try and scalp on a screen because, you know, there's no edge in trading the screen unless you're one of the high frequency boys, because, you know, they've got the market like we had the market when we were on the floor. So, you know, you want to encourage the retail trader and you want to encourage the human trader who understands the markets probably better than a machine will do for the time being. But you know, you can't, you know, the scalpers on the floor had the edge on the screens. You know, the high frequencies have got the edge, and it has to be left like that. But there is definitely room for both, or there's a need for both, I think, rather than room for.
Yeah. I mean, I think you're right. And I mean, okay, fair enough. Clinically, the textbook definition, market makers should be making two-sided prices. But I think Olivier also makes a great point, because you could absorb a great deal of liquidity at different points in time. We're going to come to a follow-up by Olivier in just a second, actually. Fabulous comment here. George Ferrari, great to see you, George. I hope you're doing very, very well. Great stuff, Alan. Happy days indeed. Good to hear from you, George. It's lovely comment altogether, and quite apt altogether. Now, Tony Laporta is adding with a comment to Olivier Guerres. They say 99% of future business is pure speculation, and the other 1% was for the end user. In other words, the locals tightened markets so the big players could get a fair market price. The locals were a necessity for life to succeed. I think that's absolutely true, Tony. And I think, to be fair as well, actually, Olivier has agreed that. And let's also take a step back, because Olivier was across the Channel, La Manche, from the rest of us at that point in time, building the MATIF, which itself was a very, very respectable futures market during the 80s and 90s, from its floor days all the way to being actually the first major European floor to be killed off for electronic trading. And when was that? 1996, I think. Olivier's going to put me right in just a moment. So I agree, I think. I mean, the locals were a necessity for all markets to succeed. And actually, Olivier adds to that, Tony. Life trading floors were a mundane affair compared to Matif's non-stop brawl trading sessions. Yeah, I think Matif seemed to have an incredible concentration, whereas Life had sort of all human life was there, and there were all sorts of people. Matif really did seem to have attracted the entirety of former French local rugby teams from the way round Paris, as I seem to recall. So I think it did lead itself to some violence much more rapidly. And of course, a great line I seem to recall from somebody, because in London, if you had a punch up, they banned you, didn't they? I mean, they banned you for a month or longer very quickly. Whereas
I remember I had a punch up on the floor once, and it was a week after I'd been elected to the board. And I was the first individual, like non-corporate person, that had been elected on the board of Life. And a week later, I was dragged out of the pit I'd had a sort of punch up with one of the lads in the pit. Fortunately, in those days, so there was no video and nothing. So it was smoothed over quite quickly to save the embarrassment for everybody.
Yes, I remember I board a trade bond trader pointing out at one point in time that it was $1,000 a punch, and he described the previous Thursday where somebody had finally got to him after years of nagging as the best $3,000 he'd spent in a long time. I'll leave you to conclude, ladies and gentlemen, what went on there. Now, Olivier Guéris is adding to Tony Laporta's comment. A great conversation here. Tony Laporta, let's say 75% speculative, 15% arbitrage, 10% hedge. Yeah, I think I'm probably somewhere about there. I usually would have said it was about 2/3, 1/3. There was a bunch of Eurex research, I think, in the late Deutsche Terminbörse, early Eurex days, that said it was roughly about 2/3 of the trading went on, 1/3 was end user, something like that. But certainly the point is, I mean, it's quite interesting how futures markets remain in a certain way relatively inefficient in terms of actually targeting the end user of the business. Although that's a whole debate for another day, I think, ladies and gentlemen. Oh, from one great CBOT trader I was mentioning, namelessly, to another who I do not believe ever racked up any fines for punching anybody in her life. Commodities doyen, former IPO-VID alumnus as well, Anne Berg. Thanks for describing the irrepressible nature of the floor, Alan. I too loved it at CBOT starting in 1981. And there are more comments, ladies and gentlemen. Sorry, Alan, I'll be back with you in a second here. Chris Messina, I'm offering a free signed copy of my book to anyone who can help convince me there is a difference between a scalper and a market maker. There you go, Olivier. There's something to while away the long winter's nights in Astana if you need something to do of an evening. And David Kempton, thank you very much, Chris Messina. David Kempton's back and saying, so, Alan, here's a great question. If they reopened Life next week, would you be there? It would be too much of an opportunity to say no.
At 70 years old, I think physically it would be too much for me, but I'd have to go down there and give it one more go.
I think it'd be great. It'd be like veterans tennis, wouldn't it? We could have a sort of certain degree. I think probably everybody would want to have shorter trading hours, 2 or 3 hour sessions at the maximum rather than standing around. Because I mean, certainly life was quite exhausting. I mean, you used to go, the earliest pits were opening at 7:30, 8 o'clock in the morning and running all the way through to 4:30, if I remember correctly. Yeah,
but I mean, you say that, but you could have a life outside it. You know, these days you can't because it's open 24/7. Or the crypto is 24/7. Everything else is 24/5. But you know, life you could have your day. You could scratch each other's eyes out, and you could go and have a pint or a beer afterwards, and you know, and you could forget the markets. You can't forget them now because they're open all the time.
Yeah, that's a very good point. And David Kempton says, in block capitals, in case you're listening to this on the podcast, right answer. So there you go. That's good to hear altogether. Thank you very much, David. Olivier Guéris, that said, the locals made a huge difference in exponentializing liquidity in plain vanilla futures. Ivy League, well-mannered graduates were making markets on the options bits. I think so. I mean, I think that's a very fair point. I mean, there was quite a sort of intellectual divide in certain respects between who was making the markets or scalping between options and elsewhere. Although on the other hand, I mean, we had as a guest a few months ago, Jason Sen. He made a very good living as an options market maker for many years. And he's definitely not a mild-mannered Ivy League type good chap as Jason Sen is, though, I have to say. But yeah, I get your point. I mean, I think there was more of an industrialization complex went around the options than elsewhere. And we've got Mark Ibbotson adding a comment here. Good afternoon, Mark. Lovely to hear from you. Great to see Alan with you on screen. PLY, a gentleman and a legend of life. And indeed, ladies and gentlemen, we're here with Alan Dickinson on his life story. If you're enjoying this, do give us a little spot of love, because the one thing that's strange is AI generally doesn't like affection, but if you give it a little like or some love, this, whatever you're watching on, whatever platform you're on, it helps push it up through the AI bots and find it more easily for other people to learn how exciting these different things are around the world. And good grief, this conversation's taken a league of its own. Tony Laporta, Olivia Garris, mundane until a group of anti-City folks tried to enter life until they met a bunch of West Ham, Chelsea and a few other rival football supporters who were mates Monday to Friday, rivals on the weekend. Needless to say, mundane was not present at the top of the escalators where the protesters never made it past. The one thing I'll observe about that day, Tony Laporta, is actually an anecdote that I was told by none other than the late, great Sir Brian Williamson. And he pointed out the fact that he thought there would be trouble early in the morning, but he was actually quite surprised that the rioters hadn't really had a great game plan, because they all turned up and queued outside the off license. I think it was a Threshers or something, wasn't it? Just up the road from not the Royal Exchange, from Cannonbridge. And they all queued outside that, paid for their booze, then went outside, drank until they got drunk and had Dutch courage, and then attacked the Life building and the various things around in the streets. Whereas, as he said, he would have thought, I mean, method criminality was surely to duff up the booze shop in the first place, steal the booze, drink it, and then try and break into the live floor. But, you know, that's something, I suppose, to think about. But a great point, Tony Laporta, you make. Messy times, Chris Messina. When I was COO of ICAP Futures in 2005, I had a ringside seat to the first expiration of oil futures on the Dubai Merc. That showed the power of end users. The 3 oil companies killed the speculators. Yes, absolutely. The Dubai Mercantile Exchange, which entirely didn't go forward in the same way that one could say that ICE Futures Abu Dhabi did, because they managed to make Murban genuinely a traded benchmark between a group of people, despite the fact that actually the biggest producer of Murban is, of course, just one company. Neil Crammond, another IPO-VID alumnus. Gosh, this is great. It's like turn back to the floor day, isn't it, Alan? Neil Crammond, with the introduction of mini micros contracts, can we expect an inflow of retail traders entering the exchange process system? Lower margins should allow folks to pay margin calls. Great question, Neil. What do you think, Alan?
I think the exchanges have missed a trick over the last 5 or 6 years. I mean, there's something like 500 million retail traders out in the world. The exchanges should be all over the retail trader. They should be introducing these micro contracts, and it's a huge source of business that they've missed out on. And, you know, the whole exchange base should be encouraging single users into the exchange. You know, they're getting raped by so many of the spread bettors, so many of the CFD players, and so many of the prop houses, or they're not called prop houses. You know, and those volumes and those positions that these retail traders are taking doesn't get anywhere near an exchange. It just gets carved up by certain people within the business, and it's it's so wrong. And I think the exchanges should make a massive effort. And there's only a few exchanges left of any size. There's a huge amount of volume to be got from going after the retail business. Anyway, I won't rant on about that. I'm sure Neil agrees with that, but.
Thank you very much, Neil. And actually, Neil, I'd love you to come back one day, because you've been making some great statements on social media recently, and I'd love to engage with you about some of them, because it's always a joy to chat with you. So I will be DMing you later. Olivia Garris is back. Neil Crammond, well, Mini Futures did that job at the Merc 30 years ago. Yeah, and isn't it interesting, Olivia, that we have the 2 biggest exchange groups in the world at the top of Young's pyramid, both going in very, very different directions. I mean, the CME have got a micro, mini, nano, you name it, of everything. And Intercontinental Exchange, they're really obsessed with where the end user is and are quite determined not to make the contracts too small, because they want to make sure that the essence of end user is still within all of their markets. Quite fascinating bifurcation in the thinking and the philosophy of these markets. Perhaps we can have a volunteer from one or other exchange to come on and talk about why they think so. Thank you very, very much for that great discussion, ladies and gentlemen. Now, Alan, I mean, tell us, we actually haven't asked you one key question. You were on LIFFE from day one. What did you trade?
Well, first I've traded the Eurodollar because that was the only contract there. Then when I opened the gilt market, I went into the gilt market, had a few years in there. I was always an extravagant type trader, so I needed sort of, speculation stuff rather than the short end. And then when the Bund opened, I went in the Bund market. And when the BTB opened, I had a little patch in there, but there was one dominant trader there who just took everyone's money, so I left that to him. But effectively, it was the Bunds and the gilts. I used to trade a lot of S&Ps on the phone, but just because I enjoyed it. And I traded a bit of FTSE, but I was never really in one pit all the time. I tended to go where the action was and jump in and out more so. Did a bit of options. But yeah, some people were homed in on one pit and stayed there forever. Gilts, Bunds, BTB and FTSE were my sort of favourites on the life market, and S&Ps out in the States.
Fascinating altogether. And yes, it is quite funny to think that when you look back at that point in time, I mean, the BTP, as you say, had one remarkably dominant local. And more interestingly, I mean, someone who hadn't necessarily been that much of a mega success until the BTP came along, and then he really hit his stride with their incredibly volatile markets. I mean, don't get me wrong, he'd been good at gilts and bunds before that, but when the BTP came along, he really hit his stride, and then ended up, I think, being a gentleman buyer and doer upper of all sorts of wonderful des reses around southeast England was the last time I heard from him.
Yeah, I see him, once a year. We have lunch or whatever. Yeah, he's a hugely successful person. I mean, he came in at the right time. He spotted the opportunity, and he absolutely grafted and made full use of it.
Yeah.
He came to me for a job, actually, his first job, and I thought he was too sharp for his own good, so I passed him on to someone else. Probably the biggest miss in my life.
That is quite funny, but it's incredible how all of those characters made it through the floor. And so then, tell me, when did you make the transition away from the floor? Were you there right until the bitter end?
Yes, I was, only in sort of. I mean, I'd sold my business in '93, I think, or '94. I sold it to Societe Generale. And I stayed sort of trading through them till the end, really. Yeah, and then I sort of pretty much retired in the late '90s. Popped down to Spain, as everyone does, to sort of play a bit of golf and party in Port Banús for a bit, but didn't do me much good. So I was there I didn't go to the last day when it was shut, because I can't remember what the last contract was. But I sort of left it when the meat of the contracts were shut down. I left it, and it was a sad time. But the world had outgrown open outcry. The whole reason for open outcry had gone through electronics, and there's no way that sort of business could ever survive. When the internet was moving at the pace it was in those days, it was always going to move to other stuff. And the market, to be perfectly honest, the market is better for it. It's far deeper. It's far more liquid. Offers opportunities for all. But I think the majority of the guys who were on the floor, never really appreciated what good an edge they had until it was gone. And a lot of the guys left the floor, tried to trade the same way on screens, and just wiped themselves out pretty quickly.
Yeah, it's a brave new world these days, and I'm actually aware of the fact we had such a great conversation. We haven't even sort of reached the end. So you ran Tower Trading in London, which is a phenomenal market making prop trading organization, very, very skillful. And then most recently, you're chairing an interesting new development in no code and low code analysis for systemic traders.
Yeah, if you ask me to explain it in depth, I'll say I can't, because I'm not that clever. But I mean, the idea behind it appealed to me as soon as I've known Lee for 20 odd years, the CEO over there. But he's always been a coder. He's always been a techie, and all the guys he's surrounded with are techies. But they were trying to develop, a sort of low code back testing model. This is before ChatGPT and all the other stuff. And obviously, when ChatGPT came to fruition, it sort of changed the way it could be done. And I've always had various thoughts on the market. I'm a great lover of tradable macro. I love thinking about the markets. I still get up at 5 o'clock every morning, and first thing you do is look at Bloomberg and blah blah blah. But so this particular thing, I've had thoughts on days days of the week, times of the day, and I've never been able to sort of, you know, code it or back test it and find out if my so-called theories are actually worth doing. So, you know, with a model where you can input by natural language, you know, you can ask it questions and it comes back with the answer pretty quickly. You know, I can test some of my theories and my thoughts, and that to me was hugely beneficial for the retail trader and for the guys. I mean, you know, you say there's 500,000 retail traders in the world, probably 1% of them can code, if that. So, you know, to back test a strategy, to actually, you know, not that many people are good on Excel, not that many people are any good at coding. So to actually go back and research some of your theories or research, you know, a thought you have, you know, hugely beneficial, getting the probabilities out. So that's what attracted me to it. And, you know, but there's a much more technical explanation than I can give. But I mean, for all retail traders and anyone who's looking to set up a system, whether it's a coded system or whether it's a mental system, you know, having some idea of the probabilities of that makes a huge sense and makes it worthwhile investigating more and going deeper and deeper into the thoughts of it.
Sounds fascinating. I must take a closer look, actually. It sounds like a very, very interesting way, particularly, as you say, when you can do it with a no-code, low-code background, because that just makes it so much easier rather than trying to hard-code things in. It
makes it accessible to everyone, which is the big thing. You know, anyone who's sitting at home, they get puffed into going on some of these courses. I mean, some excellent courses out there, don't get me wrong, but there's a lot of bad ones as well. As the same as with prop houses, there's some excellent prop houses out there, but there's a lot of bad ones. And you know, these traders get sort of so racked up in certain ways of doing things, and then, you know, they forget what they're there for. They forget to look at the probabilities of what they're trying to do. Sometimes they're on a loser straight from off the bat, and you know, I think a system, you know, and with the way the AI is moving at the moment, I mean, this, you know, it's the only way forward. It's going to again change the markets.
Well, it's going to change the markets. All those long years ago, we used to love being on the floor before we all had to move electronic, and there was that thing called Capital Market Revolution came out, and some bloke wrote a book about it, etc. with Dom Tays. Tell us, finally, Alan Dickinson, it's been a joy to hear your life story today. I actually hope you'll come back and chat more one of these days. Where do you believe the capital market revolution goes next?
I mean, you know, I've been thinking about this, and it's a pretty tough question. But I think that the way the markets have to go, especially in the UK and some of the European countries, there's a complete lack of education on the financial markets themselves. And I really do believe the exchanges should be badgering the governments, and they should be getting financial learning as part of the curriculum of every school, starting from a very young age, so people understand. Because more and more, people can't afford their pensions, they can't afford, you know, the governments can't afford to be paying people. They need to have some sort of education from a very young age for saving funds, and the magic of compounding and saving from a very young age, very small amounts that can make such a huge difference later on in life. And I think the exchanges need to help get that education system out there. And but, you know, it's not really capital market revolution, but it's something that I think, you know, you're looking at my grandkids, that, you know, how are they going to have, apart from inheriting money, how are they going to have the chance to build up reasonable pots to see themselves in later life? And I think, you know, the Americans are so far ahead of us in that. You know, everyone you speak to talks about their 401k. You know, we just don't have that in England or Europe, and I think it's hugely important, and the exchanges should do their part to encourage it.
I think that's an epicentral part of the revolution. Thank you very much, Alan. I agree. Education has got to be coming forward, particularly because there are so many ways with low code and no code and other platforms that we could deliver that material into people's homes, as well as through a school portfolio, etc. Vitally, vitally important stuff. The next step of the revolution is definitely going to be largely based in education, although at the same time, Olivier Guerras would like us to remember the fact, and I do believe he's just given us a comment that will go on screen, which was, Tony Laporta, no Millwall fans in there. So from one end of the educational purview to the other.
There was loads of Millwall fans in there.
There were loads of them. A haven for all of the London clubs at all points in time, as I seem to remember, because I was always being asked as soon as I arrived what was my favourite football team. I used to always say I'm not interested in football. I'm a Southampton fan. But look,
you know
this
Rupert
is
Lowe then.
well, yes, Rupert Lowe. Well, Rupert Lowe, famous man of winner of many prizes, including paintings at the LCH Golf Day. But I better probably not get into that. Yes, now an esteemed MP, mentioned by Elon Musk. No less. Good grief, that doesn't befall the rest of us.
Rupert was on the board with myself and Clara Furs at the time.
Yes, on LIFFE, of course. You were at that period when you had Clara, and Clara rose to be vice chairman, and then went off to other and more incredible things like running the London Stock Exchange. Incredible times, Alan Dickinson. Thank you very, very much, Joe. I'm sorry, we've done it. We've reached 1 hour. Tony Laporta, you might be surprised if you're still paying attention, because I know you were thinking you wouldn't manage to last that long.
Yeah,
but there you go. You only wanted 15 minutes, and here we are still chatting. I think one of these days we'll have to another virtual traders gathering. That would be absolutely fantastic. Thank you very much to all the people who've commented today. Messy times, Christmas Christmasina, Tony Laporta multiple times as well. David Kempton, thanks for your debut on this show. Olivier Garris, great to see you, along with other IPO-VID alumni, Anne Berg and Neil Crammond. Hello, Mark Ibbotson. Thank you very, very much for your comment. George Ferrari, it was great to hear from you too. Next week, we've got a star trader joining us, Susan Goodall. She's coming back for her 3rd appearance. Going to talk about stuff that is really, really fascinating. Watch this show, ladies and gentlemen. Why do I know it's fabulous? Because actually we had to record it, because tragically I've got to go to Miami next week, and therefore I won't be available live. This is epic. It's all talking about a multiple of trends for the course of the next, not just year, but in fact well beyond the course of the rest of the decade. Even if you disagree with it, I think you're going to find it fascinating. That's going to be IPO-VID 168 with an outlook on the stars. This has been IPO-VID number 167. Alan Dickinson has given us his life story. Thank you very, very much for joining us today, Alan. I wish you all, ladies and gentlemen, a great week in life and markets. The debate continues daily in Exchange Invest at exchangeinvest.com. Have a great week in life and markets.
Thanks.